Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 124, and this episode is a special one because last week the Better System Trader podcast reached the milestone of over 1 million downloads in iTunes. So thanks to everyone for joining in and being a part of this huge milestone. And we've got some more great content coming up too. I think you're really going to enjoy what we have planned for the next month or two. So keep on listening and spread the word to all of your trading friends. Tell everyone. Actually, if I can ask a quick favor to help me out, if you haven't left a rating or review of this podcast on iTunes yet, please go and do it now. It really does only take 1 minute to search for Better System Trader and leave a quick rating, but it'll really help to spread the word to other traders. So thanks a lot for doing that and helping out. Anyway, moving on to this episode now, we have a very special guest to mark a milestone episode, and our guest is Linda Raschke. Yes, Linda has been on the show before, back in episode 49, so it was a while ago, but it's really nice to have her back again. Now, in our previous chat with Linda, we focused on her approach to modeling the market, so we're going to continue on with that discussion now and turn our focus to trade management and exits instead, which Linda said is one of the most neglected aspects of trading. So in our chat with Linda today, she's going to share why trade management is such a neglected aspect of trading, and we're going to discuss how to model different types of exits and also the impacts of market environments on those exits. Linda is also going to share with us how volume can give clues about the tone of the market, how to use breadth measures in trading models, and also she's going to give us a little bit of info about the power of relative strength and how you can use it to target the best markets to trade. So Linda's got a lot of great insights to share with us today. I can't wait to share them with you. But first, let's hear a very quick message from our sponsor. The World Cup Championship of Futures Trading is proud to announce the Q4 Equity Index Futures Trading Championship. The World Cup Trading Championships have been hosting successful trading competitions since 1984, and we've had quite a few of the previous winners on this very show. If you'd like to take part in showing the world your trading prowess and have the opportunity to win one of those coveted Bull and Bear trophies, the contest is free to enter. For more details, check out the show notes page at bettersystemtrader.com/123. And of course, trading futures and Forex involves significant risk of loss and is not suitable for everyone. Okay, let's head on over to our chat with Linda. Hi Linda, welcome back. It's really great to have you on the show again.
Great to be back, Andrew.
Now, this is a special episode because the podcast has just passed 1 million downloads on iTunes, which is pretty amazing. And the podcast interview that we did together last year has had the most downloads out of every episode. So I think it's quite fitting to have such a special guest like yourself on a special milestone episode. So yeah, thanks a lot for coming on the show again.
Well, congratulations to you and me.
Thank you. Anyway, let's move on to trading now because that's what we're all here for. Now, in our previous podcast chat, there was a real focus around modeling the markets and how you approach the modeling and apply it to your trading. But there was a point that you kind of touched on briefly in that chat that we didn't really get much time to explore deeply. And that was the topic of trade management.
Okay.
Now, you said trade management is probably the most neglected area of system development. So if you don't mind, I'd like to take the opportunity to dig into that a little bit more today. So are you good with that?
Sure.
Awesome. All right. Well, how about we just start with why do you think that trade management is such a neglected aspect of system development?
Oh, I think it's for two reasons. A, it's so much more fun for people to think about entries and be creative on that front. And the areas of exit strategies and initial risk and so forth tend to be a little bit more ambiguous. You know, I always said that if it was so clear cut that it's time for us to exit, if it was that strong of a signal, you would certainly be reversing your position, and it's not that way. So sometimes it's better when looking at exit strategies to think about two different topics. The first is, if it's going to be just a big, giant actuarial table, okay, because obviously you can have a well-defined entry, but we all know that probably 80% of your gains are going to come from 20% of the trades, and you just can't predict that. So if you think about that in terms of having an actuarial table type of exit, it gives you a departure point. And from there, the second vein is to categorize your initial conditions that you're putting on the trade and think about, can we say that this pattern does best with a small target or a big target, or is this a case where we want to trail a stop? And the majority of things that I've done in my work dictate either exiting for a time of day exit or a fixed price exit as opposed to trailing a stop. But it's always very seductive to want to trail a stop, on your positions. And, you just have to be sensitive about how much give back you have. So this concept of trade management or position management should include your initial risk, but also protecting your open profits, okay? Because once, until the money's locked in, it's not yours, but you have to protect something of that. And then, of course, we can go into correlations if you're dealing with a portfolio, account management as well. And then lastly, if you're not so much of a system trader, a mechanical system trader, self-management has to be right up there on top of your list.
Yeah. Okay. Well, let's just jump back a step and just talk about the types of exits that are available and perhaps the benefits or disadvantages of those types of exits. So you just mentioned a couple there. Can we just go through the types of exits that you think are appropriate or that you use yourself in your own trading?
Well, I'll tell you how we do our modeling. We always have our initial entry, and then we look at how it does with several different types of exit strategies. The first would be, let's see here, exiting at a fixed ATR price. Okay, for a small target, you could say what percent of the time can we get half of an ATR, and you can of course gradiate these things and say, what percent of the time do you get 1 ATR, 3 ATRs, so forth and so forth. Obviously, the more that you play for, the win rate is going to drop down. So playing for a fixed ATR is one way to test it. A second way to test it is a time strategy. So what happens if I exit at the end of the day or at the next day's opening or the next day's close? We have one model that we sit there and say, what happens if we exit 7 days later versus 10 days later, that type of thing, to see if there's a decay factor there. And of course, these things can vary greatly. That I just have to preface all of this, that when you do your modeling, the problem when you lump too much data together is that you start to lose the difference between the states. So for example, in a range-bound market, you're going to come up with, 80% of the trades will model out this way, but obviously if you have a breakout or a trend following type of environment, it's going to model out differently. And if you lump those two together, you're doing yourself a disservice in terms of really seeing the value of different exits. So, I always try to classify the patterns within this particular trading environment or state, or I like to use the word structure, the market structure. So we've got the fixed ATR type of exits. We also have time exits. Now, I'm not touching yet on your initial risk points, how you do that, nor am I touching on trailing stops. But trailing stops, of course, would be the next step. If I don't exit at a fixed point and I don't exit at a fixed time, what happens if I just trail a stop and see what the market gives me? And I think that's what most people with our human biases would prefer to do, because I hear a lot of crying if somebody exits at their fixed price, but then the market still extends its movement, they're like, I shouldn't have gotten out. But you can't look at it as one individual trade. You have to look at it across 500 trades. And the majority of the time, it would have been the correct thing to get out. So the trailing stop is an interesting thing because I spent way too much time on this trying to figure out, what is the best trail stop? Okay. And the answer is, one doesn't necessarily is not necessarily superior to another. For example, if I test this on a quarterly basis and I run my data, let's say just in buckets, well, if I optimized it, one bucket of data might say, trailing a moving average stop. Another bucket might say, well, a volatility-based stop was best. In other words, letting the market retrace back from its swing high or swing low, such as a chandelier type of stop. And another one, you could simply trail a parabolic in some environments, even though that never tests out to be optimal. So the moral of this story is that any trailing stop technique is going to keep you in on the very best trades. And that's what we're really after. And if you do get stopped out, you can always set parameters to re-enter. People forget that. But if you don't stop yourself out and it's an ugly give back, you never get a chance to exit at that point that you should have.
Yeah. Okay. So if I can just make sure I get the understanding of this modeling of exits, do you model each type of exit individually and then combine them in trading, or do you model the combinations as well, or how do you work that difference there?
Well, I had the most brilliant coder. I mean, his name was Nigel. I know he wrote some articles for Stocks and Commodities years ago. Very, very clever with his coding because, you could always set a toggle switch. Test it with exit 1, test it with exit 2, test it with exit 3, and so forth. So once these toggle switches could be, like I said, toggle switch 1 is a price-based stop, second, or price-based exit, number 2 could be a time-based window, and you could set the variables if you wanted to, optimize this to see if there's a robust set of parameters there, data variables there. I mean, that's what you really want. If I'm doing a time-based exit, I want to see that I still have a positive expectation whether I exit day 7, day 8, day 9, day 10, and in some environments, day 7 might be optimal, but it doesn't really matter. You want to see a cluster of, parameters that it works well with. So we test each one individually, okay, because then you might want to optimize one of those little toggle switches. But then in our actual strategy, we'll usually combine 2 of them. So, for example, you might have a time-based stop that if it hasn't gotten stopped out by one method and it hasn't reached a target, but it's day 8, for example, you're best just to exit it. It's a dead market, you see? So that would be one of 2 parameters. Or, for example, you could have a hard stop, which we usually keep our hard stops pretty far away. But you could also have a variable stop, such as a volatility breakout system that trades in the opposite direction, so that's a dynamic stop changing with the market's overall environment, So we'll usually pick 2 different types, and that's how we would run with it.
Yeah, okay. So you mentioned that sometimes you would hold a position overnight or for a couple of days, but those exits are, I think you said you categorize the entries and the conditions at the time of entry. Do you monitor the conditions during the trade and then perhaps adjust which type of exit you're going to use as things change? Or are you set, at the time of entry, I'm going to use, I hold this position overnight and that's it?
It really depends on the individual strategy, but what happens when you have a portfolio of strategies, I found it preferable, the type of trading that we did, which was a little bit more short-term in orientation than, say, for example, a classic trend following system, is that a lot of strategies sort of cancel each other out or work for stops for each other. So, for example, let's say that you have a breakout pattern or a new momentum indicator that signals that you could have a run, an extended run of multiple days, 6 days, 8 days, 10 days in a row type of thing. Because these markets are so efficient nowadays. They are just, I've never seen such efficiency that once the market tips its hand, you can get 8 days, low to high, low to high, low to high, whereas before we might have had a little bit more of a consolidation or a little continuation pattern forming. You just don't see that as often. So it really pays to try and press those trades and stay with them. On the other hand, we might be trading a volatility breakout system against that. So while you have your trend, which could have a duration, holding period of like 8 or 9 days, on the other hand, these markets tend to get very crowded very quickly. So the liquidation flushes can be quite severe, or a short covering reaction can be quite severe. And just a simple volatility breakout system to trade against that, it's kind of interesting because the volatility breakout system will make money, say in one day and out the next. Thank you very much. But meanwhile, the market gave back 4 days gains. But once the volatility breakout system is exited, which is usually a 24-hour period holding time, then you start back up again in the original direction of the trend. So, it's an interesting dynamic. Most of our modeling really comes from just 2 to 3 parameters. So because it's not so sophisticated, these collection of strategies really work well together.
Yeah. When you were creating those models, were you thinking about, these strategies that kind of offset each other? Was that by design, or did it just happen over time? Or
it just ends up working out that way. It wasn't like we try to create one strategy that will dovetail with another, with another. And most of our models or strategies arise from asking simple questions. That's how we go about what happens if the market takes out the first hour's range. What happens if the market closes, at 5%, of its high or low? What happens if? And you start always asking those if questions, and out of that, you see if you can get some kind of edge or expectation.
Yeah. Okay. I just want to dig a little bit deeper into these market conditions. So you mentioned that you categorize them on entry and that you do look at market conditions during the day. What kind of things are you looking at to kind of maybe give you a clue that perhaps the mood of the market is changing and you need to switch the way you approach it? What are you looking for?
It's not so black and white, and especially, I try to follow a portfolio of non-correlated markets. So I'm dealing more with the futures market. So we've got agriculture, metal, energy, currencies, bonds, and it's pretty neat because there's always something happening somewhere. But with that said, believe it or not, you can still look at the volume for the NYSE in the first 30 minutes, and it's going to set the tone for a good part of the day for most of these markets, barring the fact that you're going to have an FOMC announcement, but I think that would be an indication of perhaps a time of year, if it's the third week in August and everybody's out at the Hamptons, or, the Europeans are on vacation or whatever, it's probably going to show up, whereas you have perhaps periods in January or at certain times in the quarter where you have heavier money flows, either, money that's got to be put to work at the end of the month or the beginning of the month or quarter. And that sort of seems to disperse itself across most of the financial markets and even spill over into some of the energies and so forth. It's sort of an interesting phenomena. It's like all the higher time frame players, to quote that terminology, or the big boys or whatever, they're either all around or they're not. So, just looking at the volume for the NYSE actually works well for me.
Yeah. Okay. All right. Thanks, Linda. Now, I just want to ask a little bit more about trade management. So we've just kind of had a chat about exits there. Are there any other components to trade management that people need to consider?
Sure. You've got to watch your correlation, because I'll tell you how we calculate our unit size. And we recalculate this at the end of every quarter. I take the dollar range for the day, an average of that for each individual market. So, for example, let's say that the S&Ps have a daily range of 12 points, and corn actually had a daily range of 20 cents. That would mean that the dollar range for corn is greater than the dollar range for the S&Ps, meaning that I would trade more S&Ps per $1 million than I would corn. Okay, so it's a paradox. You'd think corn would be a dull market, but I can remember periods where the average dollar range for corn was much greater than the S&P. So never say never, right? But obviously, silver could be one of the more extreme markets, and at times natural gas has been, and even crude oil. So I'm going to adjust. I'll take a 20-day moving average of its daily range, and then multiply that by the dollar amount, that it moves. And then that way I'm always, trading. I don't worry about the margin on it, but it makes a nice guideline to split up your unit size. And then I can always choose to do half a unit or a full unit. And, if I'm trading larger amounts in the account, then, or I add money into the account, then I adjust the unit size to that. If I wanted to scale down and take money out of the account, then my unit size shrinks accordingly. So, therefore, when you make your trade, it's always the same, risk, if you will, per whatever unit you want to calculate it into, 10,000, 100,000, a million, you see? And I've found that way you're always adjusting with the volatility of the market. So I can remember when I was trading many years ago, and the dollar range for gold was under $300 a day. And, now we've seen it be up to $2,000 a day. So obviously you would trade much fewer contracts per million, or whatever your, account size is. I'll say $50,000, than you would have perhaps years ago. And so then, of course, you have to watch the correlation, because you can have periods where the bonds are correlated, gold's correlated, the yen's correlated, and you have trades working in all these markets simultaneously. You don't. It could be a triple whammy if you're on the wrong side. So that's also a very important consideration. So, if we have positions on in very correlated markets, we might only do half a unit in each one to avoid that, big event risk, or those types of variables.
And so how often do you actually measure the correlation, or is it just something that you notice by looking at the markets?
I love using Steve Moore's site, Moore Research Center. He's been a good friend for so long, and he publishes tables for free on his site. It's mrci.com. Just fabulous research and data. He's got monthly cash charts going back 30 years, all of this stuff for free, as well as all the correlation tables. And you can set it to 90 days back, 180 days back. So anytime somebody else whose work I respect, offers it out there for free, I'm going to save myself a few hours of time and use their work.
Yeah, that's always a good thing, isn't it?
Totally.
Now, I remember from our last conversation, you mentioned that you did some modeling around breadth and some of those internal measures. Can you kind of give us an indication of some of the basic concepts and applications you see for trading with those measures?
Sure. When I started, it was like in 1981, and I had a mentor, Jerry Watson, who was actually a mathematician, and I think he had started off with a brokerage firm before getting a seat on the Pacific Coast Exchange himself. This was like, I think he started in 1978 or 79 down there. And I'm not sure where he learned it. All this stuff kind of gets taught down through the grapevine and passed on. But I used to keep track of the trend and the breadth readings and the put call ratios and shorts, specialist shorts, a few indicators that I don't use anymore today and that fell by the wayside. Obviously, specialist shorts you don't care about these days. But I used to keep track of them by hand. And at the time, for example, a 10-day moving average of the trend was so powerful in identifying overbought and oversold conditions. That's kind of fallen by the wayside the last 10 or 15 years because we had a couple super big low priced stocks, tons of volume that would just skew these things. So you have to be careful and always assess, if things are changing. I don't use that trend anymore, but breadth has always been a thought of type of indicator. And now the trick is that there's different databases by which you can get your breadth readings. It's not a standard broadcast measurement like by a data feed, like for example, my CQG is going to have a different database that it calculates breadth on than my trade station is going to have a different database. So you've got a little bit of that. What, are they including, ETFs? Are they including bond funds? Are they including, all kinds of different products out there? So a lot of people, such as Larry McMillan, keep stock only, breadth versus, that database that might include ETFs and so forth. So you just have to be a little bit careful of that. But the general principle is that if you are in a range-bound market, breadth oscillators can serve as overbought and oversold indicators. More popularly now, I think people prefer to see a divergence where breadth makes a higher low and the indices make a lower low. Then I think you've got a little bit higher confidence factor to hang your hat on. I'll tell you one of the lessons I learned the hard way, of course, like all of them. And, and this was like very early on, we're, talking 30 years ago, but thinking that just because the breadth oscillator was overbought, that is not a sell signal. And a more popularized indicator now would be that concept of breadth thrust. So you actually want to see a breadth oscillator get very overbought to confirm the fact that there could be the beginning of an uptrend, you see. So it's still going to come down to a little bit of the basic premise that we put directional oscillators in, having to quantify the environment that it's in. If it's a breakout, you definitely want to see a breadth oscillator make new highs, because then it says that you've got a lot of participation on that breakout, and then it'll have some legs to carry. So just a little bit tricky there, but I do have to say I've gotten more keen on only looking at the breadth making new highs as well as the divergences in breadth, no matter what database you're using to calculate your breadth.
Yeah. So do you think that these measures that are not really based on price but the underlying behavior, how important do you think they are in the role of trading compared to just price only?
I think you're dealing with different schools and different populations. I don't see individual traders using them so much as I do on the institutional side, where they have a longer time horizon and they're worrying more about positioning their clients or a portfolio a certain way. I don't see the same aggressiveness with individual traders trying to time that, big drop or, those types of things, using these market internal indicators like we would have 20 or 30 years ago. On an institutional basis, it's very popular and it's very powerful. And I think that it's one of 10 kind of classes that would be used to make decisions, including sentiment. All these big institutional desks and analysts are very keen on the importance of sentiment these days, which they didn't look at so much 15 years ago. But everybody's gotten pretty wise to the good stuff.
Yeah. You've got me interested now. You said 10 different classes. Can you mention a few others? I mean, you don't need to go through all 10, but what other kind of classes do you think that they're looking at? Well,
you can look at like up volume, down volume ratio. I like to do a lot of work with the ticks and the closing ticks, but that's pretty correlated to the breadth. Obviously the volatility indicators such as the VIX, or the the spreads between the contracts, the VIX contracts. That's pretty popular now. A lot of people look at the options on the VXX. So that would be a group. Like I said, the sentiment types of readings, are very popular. I don't know if I mentioned things like up volume, down volume. That's kind of gotten skewed. I think Lowry's did the best work on that initially 10, 12 years ago. But the problem is, a lot of this stuff changed when they changed the tick size on the stocks. When everything went to pennies, it seemed like we started, and they took away the shorting rule, so you can short with abandon on down ticks and so forth. We started seeing this increase, like tenfold increase in the 90% up days and the 90% down days. So I sort of take some of that with a grain of salt now. Put call ratios, there's another class for you that kind of falls under the sentiment. So that, that gives you a good idea there.
Yeah. Thanks, Linda. Now I just want to touch on one more topic before we finish up for today. Now it's based on I don't know if you remember that in our last podcast episode, we had a bunch of questions that were submitted by listeners. And there was one question, I think it might have actually been the last question that was asked. I kind of let it slide on by because we were running out of time. So I just want to ask you this one again. Now I've got it here. The question was from Marcus, and Marcus said, is there any single key understanding of the markets that you now know that you wish you had discovered a long time ago? And your response was relative strength. It took me about 15 years to figure out the power of relative strength, and it's huge. So now that we've got a few minutes, can I ask you to explain what is the power of relative strength that really appeals to you, and how does that actually feed into your trading?
Well, it's several ways. Of course, there's a whole arena of strategies that we can do with stocks and ETF on relative strength basis, everywhere from looking at, a long time horizon, how it's performing, 10 days, 90 days, whatever, relative to an index or its own group. So I'm not going to go into that because there's plenty that's been written on that. But the nice thing to understand about relative strength, it's the most raw way of looking at an immediate supply-demand imbalance and where the dollars are going. And the market has become so urgent, in the last 10 years. Everything is leap and then look, everybody's afraid of missing out. So you just get these incredible dog piles, very efficient moves that tend to peter out pretty quickly too. But, believe it or not, it works great. I can come down in the morning, and we've had all the evenings trading, by you guys in Australia and Europe, of course. But I have a little trade station grid that'll have 20 futures markets up on it, and I can look at the top 3 that's showing up in terms of the best. Let me see, what is this? best percent move off the opening price. Okay. And the opening, now keep in mind, the opening was the evening before. I'm in the U.S. session, so it would be the opening of the new day. And then, of course, you have staggered openings because the softs like sugar and cocoa and those types of markets don't open right away. They open up a little later. So even with these staggered openings and uneven field there, I can look at the top three in my list. The TradeStation radar scan is, God knows, the most beautiful, simple indicator in the world to have. And I can look at the bottom three. And if I told myself I am only going to make long trades on those top three relative strength leaders, let's see what they were today. Oh, I should. Well, right now everything's just reopened, so it's going to be not valid. But and only trade the bottom three to the short side, I'll get a win-loss ratio of 80%. You know, it's just amazing. The duration of that edge might only last one day. And of course, you know, some days it does that test and then reject. It might reverse, you know, midstream. But overall, you know, if you're just a short-term day trader or something, scalp the ones to the long side at the top of the list, scalp the ones to the short side on the bottom list. So that's a very practical, easy, simple strategy if you don't want to have overnight risk to come in and pick the stocks or the futures that are in play. That's what you really want to do. You if you're a trader, you're seeking opportunity. You know, traders are like moths to light, you know, when it comes to volatility. We want to play where there's the volatility. We want to play where there's the crazy radical movement because, you know, that's where there's opportunity and edge. So this is one way of sort of getting that main idea right, that these are going to be the most volatile or the most in play. And that's what you want.
Yeah. So if you trade mean reversion strategies, would you still pick the top three to do long positions in mean reversion, or would you switch that around depending on the style?
Lordy, no. I don't want to short the relative strength leaders, you know. I'm not going to do mean reversion on that. You know, I want to, if I'm doing a mean reversion strategy, I definitely want something that's in a range-bound consolidating type of environment. I don't want to be trying to pick tops or bottoms. I want to do mean reversion against well-defined support and well-defined resistance levels. You know, however you want to define that is up to you via a higher time frame or a volume distribution or some other type of structure, you know, pullbacks to moving averages, you know, on 240-minute charts. I mean, there's a zillion ways that you can do that, but mean reversion is a strategy that really needs to be played in a certain type of environment, which actually, if you like fading, you know, trades, I mean, the market tends to be in those environments most of the time, you know, good old consolidation, trading range, and so forth.
Yeah, so in that case, are you saying that you'd pick something more in the middle of that list as long as the volatility's there?
Well, keep in mind that this is only for that day coming in. If I'm doing a mean reversion strategy, you know, in general, I just don't want to be picking the most, you know, oversold for that day and trying to pick when they're going to stop going down. I mean, it might be a good candidate the next day, but it's sort of analogous to, if you're familiar with the volatility breakout system, I use that just because most people are familiar with that. It's a pretty generic concept, having range expansion, you know, range expansion that pulls you in. And that range expansion can just be a one-day phenomena. But I don't want to step in front of that range expansion. If I want to do mean reversion, I'm going to wait till it's just towards the close of that day and it's already flushed everybody out, you know. Then when, you know, when it's squeezed that last person, maybe it's a better time to go in, but not in the mid morning.
Yeah. So just want to clarify, when you're looking at this list, did you say you're looking at the percentage moves for the day? Do you take into account volatility of that instrument?
Let's see. This is just this TradeStation. It has nothing to do with, it's very generic. Okay, it's just it's the net percent movement off the opening price. I'm sure you could refine that and make it into ATR functions or dollar range functions, but it's just the net percent off the opening price. And I'm just using that as an example. I mean, in general, I tend to use other types of strategies or approaches more often, but this will work great.
The concept, yeah. No, that's good. Thanks for sharing that, Linda. Now, I want to start wrapping up. Usually we do the closing questions, but we've done that before, so I don't think we'll bother with that for this time. But so how can listeners get in touch with you or learn more from you?
Well, I have a website that is a blog that I've probably written a blog post maybe 3 times in the last 8 months. So you have to ignore that. I'm not a writer or a blogger, but I do have a lot of interesting articles archived. And one of these days I'll be more active on there. It just seems to be a time issue. But there is a contact me type of little box, and boy, it's so funny. I just got an email from somebody, and they wrote me a little mini War and Peace novel. I mean,
oh, goodness.
And I will write you guys back. It might not be that day. It might be 1 week or 2 weeks, but I will read anything you want to write and respond to it best to my ability. And, it's really fun. It's really fun hearing about other people's journeys from around the world, and I was so fortunate and blessed, when I was coming along through all the years, all the people that helped me and mentored me and gave me feedback and, supported me. Now it's kind of fun just to hopefully share, oh yeah, all this bad shit happened to me too, all these bad learning experiences and so forth. And maybe encourage some other people or give them feedback. And as a disclaimer, I do not sell anything. I have never sold courses. I don't have a chat room. I don't do mentoring. I'm not selling books, so anything I give to you is just coming straight from the heart. There's no ulterior motive there.
Yeah. And you've got plenty of YouTube videos and interviews and all kinds of stuff.
Oh my gosh, everything out there for free. Really, I really could write like 5 books on all that stuff and probably make $1 million, but it's probably never going to happen. So you're better off just looking at the YouTube videos.
All right, cool. Thanks, Linda. Thank you very much for that. Now, is there anything else that you'd like to mention before we wrap it up for today?
Oh my goodness, Andrew! All I will say, if you get people, asking questions or wanting to delve into a certain topic, my goodness, you have so many interesting people on all your blogs that have covered so many different arenas. But if you ever want, I'm here to share. And if you ever want to do a follow-up one, just call me anytime. I like hearing how things are going on the opposite side of the world.
You'll have to come and visit one day. Come back to Australia.
I'm coming to Australia next fall. I'm going to be there in 2018 in Melbourne.
That's right, I know. And that's going to be great.
We're going to get together and have a good dinner.
Yeah, exactly. Yeah. All right. Well, thank you very much for your time today, Linda. I really do appreciate you sharing all your loads of knowledge and your insights. And I'm sure people are going to find a lot of value in what you've shared today. So thanks again. And I do wish you all the best.
All right. I'd say good night, but I really have to say good morning, Andrew.
Yeah, it's morning here. You have a good night.
All righty. Bye.
Cheers, Linda. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.